speaking of the economy, the price of oil continuing to rise over this week. Our next guest says it is likely to keep going in the current direction, but eventually it will move lower. Stephen Schork of the Schork Group is with us now. He has over 17 years of experience in commodities. He is joining us from Philadelphia. Stephen, thanks so much for being with us this morning. The last time you were on with us, April 5th, I'm looking at the notes here, saying oil would keep moving higher, but you did say it's poised to come down by $20 a barrel. So when does it start falling? How long is it going to take?
That's a fair question. No, the skew is still bullish at this point. With spring going into the summer gasoline driving season, there's inherently always a bid in the market at this point. But again, technically, we did jump on the news of Libya back in February from about $85 to $88. Nice big fat gap on the market, on the chart right there. We will close that gap, Deirdre. We always have, we always will, and we're going to do it this time. The only question, obviously, is time. If we had to put out an educated guess, you tend to see weakness in the oil market in the fourth quarter. So we could certainly be looking at a summer of higher gasoline prices with potential weakness and a $20 recoup in price going towards the end of this year.
So that's bad news for all of our summer road trip plans. But it sounds like you're saying, look, the fundamental news as far as what's going on in Libya is already 100% priced into the price of oil. Is that right?
Absolutely. We haven't had any real headlines out of Libya now in a few weeks. We had that initial spike, $10, $15. Market hasn't really gone higher since then. We are using the disruption of 1.3 million barrels a day of Libyan exports, virtually none of it which comes to the United States, as an excuse to keep buying. But for the most part, I do believe that event has been priced into the market.
So, Stephen, I mean, we're looking at oil trading at about $110 per barrel right now. Which groups, which kinds of companies in corporate America, aside from transport, we have to say, are being affected right now by oil at this current level?
Well, you have to figure, right now we're spending about 4% of the consumer dollar towards energy. At gasoline prices at these levels, conceivably by the summer, we could go to 4.5%. In a $10 trillion consumer spending, that's an extra $50 billion, $1 billion per state that's coming out of the economy. Therefore, more money that has to go towards energy, less money we have to spend buying $4 lattes at Starbucks or buying our iPods at this point. So the consumer demand will certainly fall for non-essential goods such as entertainment, foods, going out for dinner, and consumer electronic goods.
So it basically sounds like everything that we do on a day-to-day basis, you just said individual consumer decisions are even being affected at this level. Stephen, before we let you go, any other price that we should be monitoring aside from crude oil? I know as we go into the summer, a lot of people focus on natural gas because of air conditioning power.
There's air conditioning power, and then we're also starting to end the wind season for potential hurricanes. But at this point, the supply glut, relative demand is so overwhelming that natural gas, everyone's been calling for a bullish market in natural gas for the past 3 years. They've been wrong for the past 3 years, and they're going to be wrong for a fourth year if they think prices are going significantly higher. A lot of production natural gas has been hedged between $5 and $6. There's your ceiling right there.
There's the ceiling. Stephen Schork, thanks so much for being with us.
Thank you.
Stephen, president of the Schork Group.